GM, good morning. Welcome to Milk Road Macro, the weekly macro show that reminds you that the real all-time highs are the friends we've made along the way. I'm your host, Jay Hamilton, joined by my new co-host, John Gillen. Bitcoin was ripping, and now we're back down to 116. What's going on? We're going to talk about that. Today, we are joined by the one and only Jim Bianco of Bianco Research. Jim is an industry leader with over 30 years of experience and expert insights on monetary policy, capital markets, and all things macro. He's also a regular contributor to the Wall Street Journal, CNBC, Fox Business, Bloomberg, and his many followers over on X. Today, we're going to talk about Trump's push to lower rates. Is this a good idea? And how might lowering rates actually impact the yield curve? Jim's got a very interesting take on that. We're also going to talk about inflation expectations for 2025 and what it's going to take for the market to continue this bullish momentum for the rest of the year. Before we jump in, super excited to tell you guys about our new membership that is launching this week. I'm talking about Milk Road Degen Pro. This is our new premium membership for high risk, high reward trades. I'm talking about trying to get that 100x, that 1000x playing in the crypto casino, looking for those new token launches, getting in early. It's a backstage pass to basically hunt moonshots. And because we're launching this week only, you can get 20% off the membership. Or if you want to go pro all access and get all of our pro products, you can also get 20% off that this week. So hit the link in the show notes and check out Degen Pro today. Today's episode is brought to you by Ledn. Get cash without selling your Bitcoin. It's also brought to you by Definitive, the leading multi-trading terminal trusted by funds, DAOs, and pro traders. Without further ado, Jim, welcome to Milk Road Macro.
Thanks for having me, guys. Looking forward to the conversation.
Yeah, really looking forward to it, Jim. Okay. I actually want to start with, I'm shifting up to start here on you, John. I want to start with Bitcoin at 116. What's going on? Why is Bitcoin at 116 when all of a sudden, when we were ripping and everything was looking so good? What happened?
I assume you mean why was it at 121 or 122 yesterday and now it's down to 116?
Yeah,
exactly. This is crypto week. And one of the bills kind of hit a snag with a procedural vote that did not pass. It's a procedural vote. A lot of the congressmen want to combine a bunch of the bills into one. That doesn't mean it's dead, but it does mean that it's not going to sail through as much as everybody thought initially, that there might be some snags along the way. And when you start rewriting bills and you start consolidating bills, and you have 535 big egos that have to vote on this thing, everybody's holding their breath to see that it will still pass. So I think that that was kind of the knee-jerk response that you've seen out of crypto in terms of the digital asset bill and some of the others as well.
Mm-hmm. Okay, thanks for clarifying that for all our Bitcoin holders listening in that are wondering why there's a sudden drop. Although volatility is nothing new to people in crypto, that's for sure. Okay, let's zoom out for a second. Step aside from crypto and Bitcoin. Can you just walk us through your macro framework? What's your current view on the market right now?
So let me start with the big picture. Every time the US economy has a recession or a financial crisis, it changes. It had both in 2020. Now let me be clear on that word. Change is not worse. It's not worse. It's different. It's a different economy than it was in 2019. One of the big things that's caused it to be different is remote work. Before 2020, before COVID, maybe 4 or 5% of the workforce was remote. And now something like a third to 35% of the workforce is remote. Before COVID, we weren't really talking about deglobalization, or the fancy word that's being used now is segmentation. But now we're definitely talking about deglobalization. And now we've also got on with Trump and his Mar-a-Lago Accord, talking about a reorientation of the financial world where we get Europe to pay more for security. And we're talking about trade deals. We got another one today with Indonesia. So it's a very different world that we've had. And this is the natural thing that happens when you turn a cycle. You turn a cycle typically through a recession or a financial crisis. Consequently, I think one of the big hallmarks of this cycle turn is inflation. We've had inflation now. We've averaged 3.5% on inflation since 2020. I think we're still going to average around 3% inflation or thereabouts as we go forward. And I'm thinking about core inflation, and it was at 2.9. We're recording on the day of the June CPI. Core came in at 2.9. And that what it's done with is that era of zero interest rates, money printing, very low inflation. That era is over. And it might be over for the rest of our life. And I don't see us going back to that kind of era. I think we're in a stickier inflation, higher interest rate, real interest rate type of environment that we are right now. And that is still to be understood and accepted by no less than Jay Powell. He frequently starts his press conferences by saying things like, we see broad evidence that the economy is normalizing. We see broad evidence that we're returning to pre-pandemic levels. You know, the Fed thinks that what's happened since 2020 is abnormal and that everything's going to go back to 2019. And I've argued it's not. That is a different era. That zero money, money printing, low inflation. Everybody went to the office. We only had deglobalization. That is a different cycle. We are in a new post-COVID cycle. And I think from a financial point of view, the biggest thing we have to deal with is deglobalization and stickier inflation.
Gotcha, Jim. Thank you for that. Could you kind of zoom in on that a little bit more? It's clear that in your analysis, we've moved into a different phase of the economy, and it's not going to be this 0% interest rate environment anymore. What is it that Jerome Powell and the rest of the governors of the Federal Reserve are looking at that makes them think we're still in that paradigm, and what are they missing exactly? Like, clarify that discrepancy for us.
So I'm gonna be very critical of Powell and the Fed right now. And I'm going to go back to May 31st, 2022. That was the first and only time that Jerome Powell had a meeting with President Biden. And it was in the Oval Office and the cameras were there and he was sitting on the couch. And the year over year, May 31st, 2022, the year over year inflation rate was 8.6% on its way to 9. President Biden looked at Jay Powell, effectively pointed at him and said, America, this is a guy who's going to make inflation go away. And so he gave him a big task. And the Fed has been wedded to this idea that they think that the inflation rate is going to return to 2% over the long run. And I would argue, first of all, that they don't really believe that. Because if they did, they would have never cut rates last year and there would be zero discussion about cutting rates right now. 2.9% inflation is where the core inflation rate is now. If this was truly 2019, Powell would have been brought up on charges for having inflation that high. Now, 2.9% is close enough for government work. When are you going to start cutting rates, Jay? That's because they don't believe that they're going to go to that 2%. Now, why don't they believe that? Because it's political. Because he got his marching orders from the president. They embrace that idea that they're trying to return inflation to 2%. And so they have to at least act like they believe it. Although in reality, I don't think that they do believe it. And I think that kind of, if you tell yourself a lie long enough, you start believing it. And part of that is what they're doing is that they're so committed to this idea that the inflation rate is on its way back to 2%, that they tend to forget that it hasn't been there for 6 years and that it is probably not going to be there for at least another several more years. And that we're not going to go back to negative real rates, meaning interest rates lower than the inflation rate. That's what zero interest rates were. We're always going to have some kind of positive real rate where interest rates are above the inflation rate, and that they're not ready to embrace that yet. And I think there's a lot of other people that are still struggling to embrace that idea.
So I appreciate the view of the history and of where we've gotten to. How do you expect this to play out going forward, particularly in the second half of this year? Are we set to see a rise of inflation again? Is that going to come back? How do you see this playing out, and what are you looking at to get that outlook?
Well, I think I'll start with a yes, I do think that inflation is going to rise in the second half of the year. And I think that there's two reasons for it. Reason one is tariffs. Tariffs are a tax. Tariffs are an increase in price. And unlike sales taxes, if you ever noticed, a quick thought for you, if you've ever been to Europe, when you buy something in Europe, the price is like 18 euros and then you pay 18 euros, walk out the store. But in the US, it's $17.99, and then they add sales tax to it, and then you wind up paying $18.50 something or another. And why is that? Because we did that so we could separate taxes out of the price of something. So when we check the price of something, it's $17.99. But what happens if the city or the state raises taxes? That doesn't get counted in inflation. But tariffs do. Tariffs are not separated out. They do get counted as a form of inflation. Remember famously about back in April, Amazon talked about trying to separate out the tariffs and giving everybody, here's the price, here's the tariff. And Trump effectively called them un-American and was going to, throw Jeff Bezos in jail before they stopped talking about that. And so we keep tariffs in there. So as tariffs go up, and the government is saying they used to collect $7 or $8 billion a year in tariffs. $7 or $8 billion a month in tariffs. Now they're up to 15 or 18 billion a month. Somebody is paying those tariffs. Ultimately, that somebody is going to be the US consumer. And I think you're going to see higher inflation. And as you see higher inflation come through the pipeline, interest rates are going to reflect that reality. They should be trading somewhere at around 2-ish% above a perceived inflation rate. And if the perceived inflation rate is in the 3s to low 3s, they should be 5 to low 5. Now they're a little bit below that right now. The 30 years just like 501 the day we're recording. But I do think you're going to see inflation drift higher and you're going to see interest rates drift higher.
Gotcha. So we've seen revenues coming in from the tariff policies. As you mentioned, these have been put into place. The Trump administration is loudly trumpeting, hey, we've got a budget surplus for this past month. How long do you think it's going to take for this inflation to matriculate from the applied policy of the tariffs and the money we're taking in to inflation? Because it feels like Trump and Jerome are kind of fighting about this, and Jerome thinks it's coming, Trump thinks it's not. How long do you think it'll take for that to play out and for us to feel that effect in the inflation rates in the market?
I think it started this morning. I think it started this morning with the June CPI report. If you look at certain categories like toys, appliances, furnishings, apparel, you saw hefty rises in prices on all of those types of things that you would normally get from places like China. What somewhat offset that was there was a big fall in used car prices, but that you could attribute that there was no fall in used car prices. It was just a seasonal adjustment that caused the fall in used car prices. And I think as we go forward, you're going to see more of that. Now, maybe you'll get something in, restaurants and airline tickets and other services like owner equivalent rent or something to come down to somewhat offset that. But I think you're going to start to see those numbers start to move up. Now, the next time I think you're going to see those numbers is when we get the PCE report at the end of the month, the personal consumption expenditures, which is the Fed's favorite metric. That survey, that measure of inflation uses the same survey as CPI. You could take the CPI inputs and you could reweight them to PCE, and Wall Street will do that tomorrow. And the reason I say it tomorrow is because there's a couple of categories in the PCE report that will come out with the PPI tomorrow. And they'll give you an estimate of what they think PCE will be at the end of the month. And they're usually very accurate because they've already got the raw material for it. But right now, what they're saying is it's looking like a 0.3 or 0.4 core inflation number in PCE because those things like used cars and owner's equivalent rent have a much lower weighting in PCE, so it doesn't depress it as much. But furnishing and toys and apparel and things like that have a bigger weighting. So that number is going to go up even more. And that's the inflation number that the Fed focuses on. So I think you're going to start to see it, fairly soon.
Gotcha. Okay. So now we've seen this tug of war going back and forth between Trump and Powell. There have been rumors that Powell is considering resigning. There's some new news about Trump trying to bring up charges about Powell misrepresenting things at the Fed and trying to find cause to fire him. Right now, it looks unlikely we'll see a rate cut from July, but the Fed dot plots are suggesting it becomes more likely later this year. What happens if Trump or some new Fed chairman wins this argument and they start cutting rates prematurely? Does that put us at risk for even greater inflation, or how do you see the risk of that fight playing out in the market?
Yeah, so a couple of things. This whole idea that Trump wants to fire Powell, I was of the opinion that this was more theater than substance, that Trump really doesn't want to fire Powell. he wants to keep them in place and use them as a punching bag. I've come around to the opinion now that no, he actually does want to run him out of town, and he wants to get rid of him sooner rather than later. And Powell doesn't have at-will employment. At-will employment would be the Treasury Secretary. Trump could just announce anytime he wants, or any cabinet member, I want you out of here, leave. And I don't have to give a reason. He can only fire Powell for cause. For cause is you commit a crime or something else along those lines. And he can't, and for cause is generally, it's never been tested, it's never been defined. But most people will say it's not, I disagree with you with monetary policy. You can't fire him for that. But that's why they're focusing in on this renovation of the Fed's Eccles building in Washington. If you've ever been to it, it's a giant marble edifice. And they're up to $2.5 billion that they're going to renovate this building. Some of the plans have been calling for private elevators and terraces and beehives. I don't know why the Fed needs beehives, and other things like that. And when Powell was asked about this last month at his testimony, he said, there are no beehives, there are no private elevators, there are no private terraced roof gardens and all this other stuff that's run the cost of this thing up to $2.5 billion. Now, technically he's correct because they haven't built them yet. And there are some plans that called for this. There are other plans that didn't. The plans need to be approved by a planning commission. The reason I'm bringing all this up in such detail is this is the type of thing that the Trump administration has glommed onto. You lied to Congress. You violated the planning commission law. You were planning on doing this, and now you're trying to backpedal and say you're not going to do it. And so therefore, you've given me cause to fire you. And I think that is, I wouldn't put the odds of Powell at better than 50% he's going to get fired, but I would say it's rising, and every day it continues to go up. And I think it'll come to head in August. I think when we get through the July meeting, we'll find out what Trump's reaction will be to the Fed when they do not cut rates in the July meeting, because as you pointed out, the market is only assigning a 2% probability that they will cut rates in the July meeting, 98% that they'll hold them steady. And after today's inflation report, when I talked about maybe there was some tariffs in there, the September 18th meeting is down to 54% that they'll cut rates, 46% that they'll hold. Now, 2 weeks ago, that was 90% they were going to cut rates, and now we're down to 54%. So all of a sudden, that meeting is starting to slip away. And when Trump becomes aware of this, I think that there's a real chance that he would fire him. And that would just create all kind of chaos. Does he leave? Who takes over? Does Philip Jefferson take over? He's the vice chairman. Or does somebody else that he appoints take over? Does that change monetary policy? Does that mean they're going to cut rates because they fired Powell? Everything is going to get thrown in the air if that happens.
Selling your Bitcoin should be a last resort when you need cash. That's why there's Ledn, the trusted platform for Bitcoin-backed loans. You can unlock cash in as little as 18 hours with no monthly interest payments and no prepayment penalties. They've issued over $9 billion in loans and never lost a single Satoshi of client funds, even during the chaos of 2022. If you're a long-term hodler, this is the move. Get liquidity without selling at milkroad.com/Ledn, spelled Ledn. In traditional finance, whales use the Bloomberg terminal. In crypto, they use Definitive, the trading terminal built by Coinbase alumni, which lets you trade across every major chain out there. Definitive's combination of low fees and advanced order types like limit, stop loss, and take profit make it one of the best on-chain trading experiences there is. The kicker, Milk Road listeners trade free on their first $25,000 in volume. Visit milkroad.com/definitive and start trading like a pro today. And if that does happen, which way do you think the market responds? Do you think the market?
I think there's a real chance if we saw him fire Powell, there's a real chance it would look a little bit like early April in that respect, because we won't know what's going to go on. We won't know what's happening at the Fed. And it kind of matters in a lot of ways. look, the proper way to do this, by the way, is he doesn't want Powell. I get it. Powell's term is over in May of next year, in 10 months. Just announce a new person, get them confirmed, give him his gold watch and send him on his way and get your new person in town. You don't need to throw the entire organization into complete and utter chaos, but that is the risk that we face right now.
I want to ask one more question on this question of rates. It seems that Donald Trump's justification for pushing for these rate cuts is not to do with inflation or other things, but he's saying, if we were 3 points lower, we could refinance our debt. It would save us $1 trillion of debt payments. So it seems to be that Trump is arguing that the Fed should factor in the fiscal situation of the United States into their monetary policy, when historically the Fed's mandate has been to maintain price stability and full employment. So it seems like Trump is arguing they should use, the fiscal situation as a thing to consider when they're setting monetary policy. Do you see that as a valid ask on Trump's part, or do you think that that's a mistake in policy? And how do you think this is going to play out going forward if the Fed does start to consider that?
I think it's a complete mistake. That's fiscal dominance. A little bit of history. Prior to 1951, the Fed and the Treasury were kind of one and the same. If you go back to the 1930s, the Treasury Secretary actually was a member of the FOMC. And then in 1951, they had the Fed Treasury Accord, which kind of separated those out. And the fiscal situation of the United States is the domain of the Treasury Secretary. And the Fed is to not consider that at all. And they don't consider that at all. And one of the reasons is that when you get into this whole idea, well, if we lower rates, we make it easier for profligate government spending, because that's what he's basically saying. He's saying we have too much government and we have to borrow to pay for that government. And now those interest costs are too high. We don't want to get rid of government. We want the government to be further into everybody's life. So we want you to lower interest rates and make it easier for us to put more government into your life. There's my libertarian streak coming through from you. And they're going to make it. And so that should not be a consideration for the Fed. And I don't think it will be a consideration for the Fed. But I do think that the other big mistake that Trump makes is he'll say, we should have rates 3 points lower. We are the best. We are the best country. We are booming. Everybody wants to be here. What he's doing, as I'd like to joke, is he's reverting back to being Donnie from Queens, the real estate developer. When he finances one of his buildings, he gets a low interest rate when the bank thinks that building is a good credit. So he thinks about interest rates purely in terms of credit. The better the credit, the lower the interest rate. So he's walking around, forget Moody's downgrading us. He's walking around going, we're the best credit in the world. Everybody wants to be here. So therefore, we should have the lowest interest rate. Well, that's not the way it works with sovereign yields, is what we're talking, government yields. Government yields are not, especially developed country government yields, they are not a function of your ability to pay. And the reason that they're not a function of your ability to pay is, here's the dirty little secret. Everybody can pay because everybody's got a printing press. And I could print up worthless pieces of paper, hand them to you and go, there, I just paid you back your principal. Now, you may not like what the valuation of those pieces of paper are, meaning the dollar falls and you get hyperinflation. But there's never going to be a situation in a developed country where I don't give you pieces of paper when you're owed an interest payment or a principal. So it really comes down to inflation, growth, supply, how many bonds you're going to issue. That's what determines your interest rates. And if you look at some of the accepted models of how you're supposed to value where should interest rates be in a country, one of the accepted ways that I kind of subscribe to is nominal GDP. What is the total inflation plus real growth of a country? And ours is around 4.5% to 5%. So where should the risk-free interest rate in that country be? The sovereign yield in that country be? Yield, the long end of the yield curve, around 4.5% to 5%. So we are appropriately priced. The interest rates we have now are where they should be. The fear I have is if Trump fires Powell, brings somebody in, and then they immediately start pushing rates down to 1%, the bond market's going to look at that going, everything's fine. We have a decent economy. There's some issues, but no big problem. Interest rates are where they should be. So now you're going to juice this thing by cutting interest rates and making it easier to take out loans, to basically leverage yourself up. And we in the bond market see that as ending with inflation. And we see that with ending with even higher growth. I don't want to have anything to do with the bond market. You sell bonds and interest rates go up. We saw that last year. The Fed cut rates 50 basis points in September, 25 in November, 25 in December. Cut rates 100 basis points. The bond market didn't think that was the right policy. What did 10-year yields do? They went up 100 basis points at exactly the same time. You're seeing that in Europe. They've cut rates 8 times, 25 basis point, 8 cuts in Europe, taking their policy rate from 4 to 2. What have 10-year French and 10-year German yields done during that period? They've gone up. Because in Europe, you could argue that they're also thinking, you've got the wrong policy. You're cutting rates and you're producing at the same time higher long-term yields. Now you could argue, there's more supply and everything else, but that's the point, is that the market point is saying that is not the policy that Europe should be having. So you have to be careful. What Trump also seems to be assuming is that interest rates are kind of a made-up number. So Jay, make up a lower number so that we don't have to pay as much in interest costs. But they're not made up numbers. And if you make up a lower number, you run the risk of having a bad reaction in markets. We saw a mini version of that from September to January, when the 10-year yield went from 3.6 to 4.8 when the Fed was cutting rates. And if we ever get to the point where Trump can get his wish of a 300 basis point cut in rates in this environment, that could be very bad. Now, maybe in May of next year, he gets his guy in place, and that guy in place wants to cut rates 300 basis points. Maybe the economy's falling apart. And maybe at that point, the marketplace would say, yeah, we do need big rate cuts. And it would be okay with them. They cut rates and yields come down. But we don't know what the economy is going to be in May of next year. But if it's anything like it is now, then any kind of aggressive cuts in rates could actually backfire and produce higher long-term yields.
I want to bring this back to something we started out with, which was Crypto Week in Congress. And we'd spoken about how the Clarity Act had hit a snag in the process. However, the Genius Act, the one around stablecoins, has been greeted with much more support and enthusiasm from both sides of the aisle. The stated goal there from both Congress and the Secretary of the Treasury, Scott Bessent, has been to pass this to give some structure for U.S. dollar stablecoins, and they expect to get, some estimates is some between $2 to $4 trillion of demand for U.S. bills. Do you see that as being a successful policy effort to help support demand for U.S. debt, or do you think that that's going to be misguided and have different outcomes that they're expecting here?
Yeah, I'm really mixed on this thing, and I'm kind of leaning towards that it might not be the best idea. What they're basically doing is they're trying to turn stablecoins into a version of a money market fund. You give your money, for those, if you're not familiar with money market funds, you put your money in a money market fund. It has the same price, the NAV, the net asset value, every day, $1. And every dollar you put in, they give you a share that's worth $1 every day. And they invest it in a equal $1 worth of treasury securities or repo or some super safe investment. Well, that's exactly what a stablecoin is. Stablecoin is a $1 price. And what they want to do is they want to say, if you put $1 into a stablecoin, that dollar will go into treasuries. Okay, fine. You're reinventing something that we've had for 50 years called a money market fund. There's a big difference, though. In the money market fund, that $1 NAV that you have throws off interest. So you get paid almost, they put that money, that $1 of yours, into a treasury bill that yields 4%. They pass that 4% yield along to you. In a stablecoin, because some of the community banks were worried about the competition of stablecoins, they said you cannot pass that interest cost along. So this is why I think Circle's stock price is going through the roof. You guys are going to put your money in a money market, into a stable coin. You're going to get no interest. Billions of dollars are going to go to Circle or whoever else, JP Morgan, whoever else decides to issue a stable coin. They're going to put that in treasury bills and they're going to keep all the interest for themselves, is what they're going to wind up doing. So in one respect, I'm like, well, why is anybody going to put any money in this? I've got money in a money market fund at 4%. Why am I going to take that out and put it into a stable coin that's yielding me 0? Now, one of the other arguments that people are making is, well, we'll use the stable coins for other purposes. Well, what are 90% of stable coins used for right now? They're used for trading. There are no dollars on a blockchain. There is a dollar proxy called a stable coin that's on a blockchain right now. So we use them for pricing, right? We talk about the price of Bitcoin, $116,000, right? Well, there are no dollars on a blockchain. There are stable coins on a blockchain, and that's how we price it. We don't price it Bitcoin to ETH or Solana to ETH or something like that. We can, and we do in some Uniswap pools and stuff like that. But mostly we price them against dollars. So what are all these stable coins being used for? They're used for trading. So if there's $200 billion of stable coins now, and they think we're going to go to $2 trillion of stable coins, how do we get there? That's easy. Price of Bitcoin goes to $1 million. Because if it 10x's, then we'll need 10x more stable coins. Well, if that's your call, that the big price of Bitcoin is going to go to $1 million, then just say, we think the price of Bitcoin is going to go to $1 million. Who cares about the stable coins? But they're making up this idea that, oh, we're going to be buying lattes with them at Starbucks and we're going to be buying stuff on Amazon. I already have Zelle. We already have Venmo. I have a money market fund that earns me interest. Why am I going to take that money and put it into a stable coin that doesn't earn me interest? Now, there might be an avenue for international remittances that I could take a stable coin and I could pay somebody in a foreign country and not go through all the hoops that you have to jump through in international remittances and the costs. And that's a valid argument. But that's been around for 10 years. The first stable coin was invented by Tether in 2014. Nothing has stopped them for the last 11 years to have mass adoption of stable coins to use for international remittances, and they largely haven't. And it hasn't been that they're waiting for the US Congress to decide on stablecoin legislation so somebody in Brazil can pay somebody in Germany in a US dollar stablecoin. That's not what's been holding them up. They've just not been the tool that people thought when it comes to medium of exchange. And so I don't think that it's going to be the medium of exchange. Finally, I was big in the stablecoins, during DeFi summer in 2020. Full disclosure, I got wrapped up in the UST debacle and my Luna went to nothing like everybody else. And what I really got, I was into Frax and I was into a lot of these other ones. What I really liked about it was the creativity. And I loved DAI, and I still do, and I still own some DAI. And I love DAI and everything that it was involved with it. And that the creativity and the ideas that they were trying to do with money. And I wish we would continue with that. Look, there will be failures. There will be successes. But now they're saying no more creativity. We've decided what a stable coin is, and we're going to fix it in time as basically a money market fund without interest. And I think that that's going to severely limit it. But let me come back to the same thing. If you want $200 billion of stable coins to become $2 trillion, it's not going to be because everybody's going to say, the hell with Venmo, I'm going to get some USDC to start buying stuff on Amazon. And they've already got Venmo to do it. They're just going to do it with Venmo, keep their money in a money market fund and earn interest. The way you're going to get it to $2 trillion is you're going to have to have $1 million on Bitcoin. Now, maybe that's what happens. But say it. You just think that Bitcoin's going to go to $1 million, as opposed to this convoluted argument that we're going to have $2 trillion worth of stable coins without talking about that we're going to have to 10x the price of Bitcoin.
Gotcha. Yeah. No, I think the point about not wanting to stifle the continued innovation is an important point. And I'm hopeful that out of Crypto Week comes a framework to support that as we go forward. You said something that really caught my interest, which was Bitcoin to $1 million. And I don't think that was a price forecast, but I do want to hear your thoughts on the outlook for crypto through the rest of this year. You've said you see us in a different economy, in a different interest rate environment, in a different inflation environment. How does that play out in the crypto markets and specifically with Bitcoin?
Well, I've been a big, fan of crypto for a long time. I know people, get confused on my, my views because I've been crapping on the Bitcoin ETFs for about a year and a half as well. And the reason I've been crapping on the Bitcoin ETFs is it comes back to that innovation word again. I think that the financial system, the TradFi system, is ripe for disruption. It needs to be disrupted. And I think that in order to get it to be disrupted, we have to get people on chain and we have to allow for innovation. And what I saw, the Bitcoin ETFs and their adoption is, here comes the boomers, and all the boomers are going to put 5% of their, wealth managers are going to put 5% of their money in, IBIT, and it's going to create all of this. It's going to create all this demand, and largely that's what it's done. My complaint was, if you really want to see Bitcoin to 1 million, if you want to see Saylor's argument that Bitcoin's going to go to 13 million in 20 years, what you need to, you cannot say that, the dollar's going to stay the reserve currency, the S&P is going to go to 60,000, and Bitcoin's going to go to 13 million. Because if you said that, we're going to have so much financial assets that a Honda is going to cost you $500,000. That's the fear. The way you get Bitcoin to 13 million is the TradFi system migrates to Bitcoin. And that pushes it up as the TradFi system shrivels away. We didn't start with 13,000 taxis in New York City and then invent Uber and say, okay, good, we'll have 13,000 taxis and we'll have 40,000 Uber drivers on top of the 13,000 taxis. No, the taxi drivers all went away and they migrated to Uber drivers. So what I saw with the ETF was, I was like, no, you want the boomers to go on chain. Here's my ledger right here. Go on chain. Learn how to buy this stuff on chain. Learn what's going on everything. When you do that, then we could start talking about real adoption of this system, that we're now creating a new financial system. What I worry about, and I'm kind of back and forth on this, is all we've done is we've created a speculative degen tool that we just speculate with Bitcoin, and it's highly correlated to the NASDAQ. I wish it wasn't. I wish it was taking on a life of its own. I would like to see the NASDAQ get the crap kicked out of it and Bitcoin not go down the chute with it. But every time the NASDAQ gets the crap kicked out of it, Bitcoin goes down with it as well, meaning it's a speculative tool. So I would like to see this type of broad-based adoption come. Now, problem is, I'm on the fence on this. I think if you get the adoption, man, I'm right there with Saylor at 13 million. I really am. But if you're going to say, no, all the boomers are going to just buy IBIT and we're just going to wait for more boomers to buy IBIT and then more boomers to buy IBIT, and we're just going to play the FOMO game, and that's going to get us going anywhere, it will for a while. And then Bitcoin throughout its life has had 80 to 90% corrections 7 times. And if we're going to play the FOMO game, we'll have an 8th. Is what we'll wind up doing somewhere down the line. I would rather not see it have another 80 or 90% correction somewhere down the line. And the way you do that is you get true adoption, that you're building a new financial system. Everybody get away from the New York Stock Exchange, get away from JP Morgan, forget the Federal Reserve. Let's all get on chain because that's a better system. And so we kind of lose that. And that's what I really want to see happen with this. That was what my criticism was about the ETFs and the degen arguments, which got mistaken by a lot of people that I was bearish on the price. I wasn't necessarily, I was bearish on where we were going. And I would really like to see us continue on that hope that we're building a new financial system.
Yeah, I appreciate the passion and the perspective. I think there's a lot of wisdom in that, and there's a lot of things that can drive price, a lot of ways people can look at these assets and how they can develop. So I really appreciate the framing of that. I think I want to bring us back to the macro picture here to kind of like tie this up for us. You know, you've talked about how we're in a different paradigm than we used to be. There's disagreement between sitting presidents and Fed chairmen about interest rate policy, about inflation policy, tariff policy. I think the big thing that has marked this summer for me and for most investors, I think, has been uncertainty of what data to rely on, which way things are going to go. You know, Bitcoin goes up to 123,000, down to 16,000. What do you do? And then, you know, like some of this inflation data, jobs data, the data come out, it gets revised. It's a totally different picture the next month, right? So if you're an investor, you're talking to investors right now, you know, you've got 30 years of experience. What should they be paying attention to? Where can they hang their hat on information to guide them as they try to navigate the uncertainty in the second half of this year?
Yeah, that's a hard one to answer because there's so many different ways that you could be talking about investors. Because the investors that I talk to run the gamut, from very risk averse, either funds or older people to very aggressive younger people, depending on which way that they want to go. But let me make a couple of broad comments. Don't get too hung up on one particular item. Now the Fed's going to print, or there's going to be zero interest money, or we're going to have deflation or something like that. Great thing about a capitalist economy is it remakes itself constantly. So the question you always have to ask yourself is, here's a problem. And the last big problem we had was Trump had a liberation day. The market fell out of bed. Well, can the market remake itself from that problem? Yes, Trump called it off for 90 days, and then the market turned around and it rallied. We had another problem in 2020 with COVID and the shutdown. Could we remake ourselves out of that problem? Yes, we had the vaccine in November of 2020. And so bear in mind that whenever anybody starts talking to you about problems in the economy, and there can be, that we tend to talk about them as being intractable and unfixable. Nothing is intractable and nothing is unfixable. So the first question you want to ask yourself is, here's an issue. Market's not behaving the way I want. Why? How do we fix it? And how do we go about fixing it? For a long time between 2010 and 2020, the answer was print money. I don't think that the answer right now can be to print money because we have too much inflation for them to print money anymore. So that would be the first thing I would look at. The second thing I'd probably look at is, I think that the most important market right now, in my mind, and this is probably my bias because of where I sit, is probably going to be the bond market. It's going to be interest rates. Why did we have a 25% correction in 2022? That's because we had 9% inflation and bond yields, or the funds rate, went from 0 to 5% in a year. Interest rates, I'll do an old quote from 30 years ago, a guy named James Carville, who used to be an advisor to President Bill Clinton. And he famously said, I used to think when I get reincarnated, I want to come back as the Pope or a 400 hitter. But I decided I really want to come back as the bond market because the bond market can scare the hell out of everybody. And I still think that that's the case today. The bond market can be the destroyer of worlds if it's not properly appreciated. So, I've heard people say to me, younger people, oh, who wants to invest in bonds? They suck. They don't give you any returns. No one's going to invest in bonds. Okay, you might be right. But here's the thing about the bond market. It's got an insatiable appetite that it needs to be fed, and it will destroy every other market to get itself fed. In other words, I will take interest rates up. You don't want to buy bonds with a 4% yield because you don't think that's enough? How about 5? How about 10? How about 30? What number do I need to suck your money out of your crypto account to feed the bond market? And what does 10 or 20% yields do to an economy? It destroys it, is what it winds up doing. So watch the bond market, I think, for starters. Now, I'm using extreme numbers just to get my point across. I do not think we're going to see anything like 10 or 20% yields. I'm just using extreme numbers to hype my story. But I do think, though, you want to understand the bond market because it is something that a lot of people don't invest in, a lot of people don't understand. And then like 2022, they wonder, why is it destroying the world? Because it is at the senior capital level. It needs to be funded first. And it can be funded by taking up interest rates to make everything else unattractive that you all want to put your money in the bonds. And what we want to ultimately have is not to have such an insatiable need to fund so many bonds, lower interest rates, Jay, by 3 percentage points so I can expand government. Well, that sets you up for this insatiable need to fund so much government that the only way you're going to do it is sky high interest rates and wreck everything else. And so learn about the bond market, learn a little bit more about what it's doing. And remember, nothing is for sure. Everything can be remade. So without knowing a specific instance of what you're talking about, that was the way I would argue it.
Jim, absolute pleasure to get you on the show today. Your takes are, as always, legendary, and your storytelling is one of a kind. We really appreciate it. And to everybody listening in, if you need help understanding the bond market, you should subscribe to the Milk Road Macro newsletter, which comes out twice a week in your inbox and talks lots about these exact concepts that we're talking about today with Jim, and make sure you understand how to frame it as an investor. Thanks again for joining us today, Jim.
Thank you. Enjoyed it.
Thanks as always for listening in, folks. I have to remind you, none of today's episode is financial advice. I'm not your financial advisor. John is not your financial advisor. Jim is not your financial advisor. You should always do your own research. And if you need any help with your finances or with your investments, you should speak to a professional. Thanks for tuning in. Have yourselves a wicked awesome day. We'll see you back again next week. And finally, I've got to give a shout out to our partners over at Nexo. Have just partnered with the DP World Tour, one of the leading golf tournaments in the world, 45 tournaments across 4 continents, and they're going to have the Nexo Championship debuting this August in Scotland. So keep an eye out for that, because this is one of those things that feels very marketing talk, but I get super excited because when you think about sports and the crossover with the attention that it has and how many leading global brands are sponsoring massive sports tournaments, it's pretty exciting to see crypto brands sponsoring large sports tournaments as well. So hat tip to Nexo. Way to go, guys. Thanks as always for doing what you guys do in the space. Thanks for tuning in, y'all. Have a wicked awesome day. We'll see you back again tomorrow. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.